Hello and welcome to Livewise Buy Hold Sell. I'm Grady Wulff, and today we're looking back on what has been a surprisingly strong first half of 2024. Despite interest rates remaining elevated and the concept of higher for longer and inflationary pressures remaining sticky and stubborn, we've seen investors push global markets to record highs. So today, to discuss their insights and decide what the outlook is for 2024, the second half of the year, I'm joined by Steve Johnson from Forager Funds Management and Luke Laretive from Seneca Financial Solutions. Gentlemen, thank you for joining me today.
Great to be here.
What a first half we've had. It's been a very strong first half. Steve, I'll start with you. What's worked, what hasn't? What's your outtake for the first half?
It hasn't been as good here in Australia as it has been globally, and that's probably indicative of what's working out there. You've had a small number of global mega cap stocks really driving the over-market return. A really interesting statistic, there are more stocks last night hitting 52-week lows in the US than 52-week highs, yet the market itself is hitting an all-time high, and everyone knows the Nvidia story is driving things. It's been a bit the same here in Australia. We've had large cap stocks again doing better than small cap stocks. We were all saying at the start of the year it's going to be a great year for small cap stocks, but it has been getting better out there in small cap land. There's some stuff that's working and some stocks that have done very, very well. It
is interesting because a lot of investors got it wrong thinking it's a widespread rally, but it is the big names like Nvidia driving everything. So Luke, what do you think? What's gone right? What's gone wrong? Talk to me about the first half.
Yeah, I think the resources sector has underperformed the industrials, and that's kind of the two ends of the barbell here in Australia. It's been about 17% underperformance, and so the big miners, the iron ore stocks, they've been belted, and the banks are trading at record highs. So that's really been the tail of the tape at the moment, and as Steve said, the smalls have been struggling relative to those large cap companies.
Now, I'll stay with you. Looking into the next 6 months with a crystal ball, obviously, what do you think is going to work and what won't work?
Well, what won't work, I don't think the gold miners, some of the low quality gold miners that have been running are going to do as well in the second half. I think that trade will sort of normalise to cost of labour and I suppose the quality of the assets more so than just people chasing gold stocks. I think what will work is probably property and infrastructure. I think the sort of interest rate story is going to be a tale of bond yields sort of declining, interest rates getting cut or people drifting closer towards cutting rates. So those stocks have been a bit disappointing in the first sort of half of the year, and I think maybe they might come back in the second half.
It is a tale of industrial REITs right now, isn't it, with the AI movement, diversified exposure to AI. Steve, what major events are you expecting to shake up the markets in the second half?
Yeah, I think we will see more of what we saw in the first half of the year at the small cap end, and that is businesses that tick the right boxes. There's actually plenty of demand out there for them. So I think a year ago, everything was just cheap in small cap land, and you've had some pretty strong rallies. And we own a stock called Gentrack, which is up fourfold in the past couple of years. We both own RPM Global. That stock's done really well. They're cash generative, they're growing, and people are flocking to those types of businesses. So I think if you can find the stocks that can bridge that gap, i.e. the perception at the moment is that they're not in that category, but they can prove themselves over that next 6 months, I think they'll do pretty well. And look, I think overall the Aussie market, we started our Australian shares fund 14 years ago.
Wow.
The market's done 8% per annum since then, 4% of dividends, 4% of capital growth. That's exactly what you should expect from long-term equities, and you can probably expect it from here in Australia from now on, because it's a resources commodities. Those stocks have not been hot globally, and our market has not been hot, and it's because of that pretty sensibly priced.
Absolutely. Now, talking about changes to your portfolios and your clients' portfolios and funds, what are the biggest changes you've made, or one change you've made in your portfolio this year, and why did you do that?
I'd say we've been doing more recycling than usual because of what I just spoke about. We've had a really good year in both of our funds, and some of those stocks are now reaching fair value, or in the case of a Gentrack, I'd say even fairly optimistic valuations.
Too high.
And at the other end of the spectrum, there's a lot of stocks out there that have halved. We're seeing a lot of portfolio transitions going on in small cap land, so people are winding up funds. Stocks are halving and more on the back of any sort of downgrade or bad news. So there's plenty of opportunity to recycle. Lots of similar types of businesses. I wouldn't say we've made a dramatic change to the types of businesses that we're investing in, but we're still pretty excited about the opportunities we're finding.
It's a very news reactive market right now, isn't it? Now, Luke, I'll talk to you about that. Exactly the same question. Any changes to the portfolios or funds, and what you're looking at and why you did that?
Yeah, I suppose in our Large cap, the biggest change we've made is we've cut our ResMed position in half,
Yeah.
a bit more than half actually. Just taking some profits there. That stock's had a pretty good run. Still think there's probably maybe 15 or 20% more upside. It's not that that stock's a bad choice or wouldn't fit in a portfolio at the moment, but for us, just kind of managing, like Steve said, there's opportunities out there. There's other things we want to pursue which maybe have a little bit more upside in this market, and certainly in the smaller end of the market. There's been sort of idiosyncratic opportunities across small caps, and it really is a question of just taking advantage of those as they sort of pop up.
And with ResMed, we'll stick with that for a second. Did you think the Ozempic sell-off, fear-driven sell-off, was an oversell, or did you see it was kind of how the news and noise affecting markets right now?
I think you've got to sort of take sometimes the reaction the market has with a bit of a grain of salt.
Yeah.
And certainly, whilst it probably was a little bit scary, as for a lot of shareholders, we weren't really there then, and that kind of threw up the opportunity for us, I suppose, to have a deeper look at it, think about where ResMed might be over the next 5 years, and certainly from our perspective, that was an opportunity to buy a great business at a really reasonable price.
Yeah, absolutely. I don't think sleep apnea is going anywhere anytime soon. Now, opportunities over the next 6 months is what we just spoke about, but what could investors get wrong in your opinion?
Being too bearish.
Yeah.
So I think we've got to sort of start asking ourselves, what can go right rather than what can go wrong all the time. It's our natural kind of risk aversion, I suppose, coming through. But from our perspective, it's a market. There's opportunity in the market. Valuations might seem a little bit rich if you kind of look at things on a sort of raw earnings basis as they are today, but certainly a lot of these businesses are coming off sort of cyclical lows in earnings, and the cycle is starting to improve for a lot of businesses. So from our perspective, just got to ask yourself what can go right.
And Steve, what potential mistakes do you see could be unfolding right now in an investor's point of view?
I actually agree with that point. It's been a massive mistake over the past 12 to 18 months. I think as interest rates went up, we had a lot of clients going, I can make 5% in the bank here. I can sit out this equities market and wait until I'm confident where inflation and interest rates are going to go, and then I'll come back and put my money into equities. And all of a sudden the market's 25, 30% higher. And like I said, when you can expect 8% a year of returns, you can't afford to miss 25. You've just missed 3 years of returns. And I think just getting your portfolio allocation right and sticking to it is far more important than trying to predict where the market's going to go. And then I've never seen a more momentum fad-driven environment than we're in. It's a casino out there. It's been driven by social media. Everyone's just piling on to one theme after another. And I think for the average investor, that's really, really dangerous. There's a lot of people out there that are intentionally trying to steal your money off you. They're running quite sophisticated schemes to pump up the prices of some of these stocks, and just don't get stuck in it.
A lot of investors, there are positions that people take in some stocks and keeps you up at night. What's cost you sleep in the past 6 months, and what have you regretted not getting into or regretted buying into?
I like talking about errors of commission rather than omission. It's a really fond fund manager thing to say. I've never got anything wrong. I only missed the great opportunities here. Tourism has been the one for us that's been costly. We own both Experience Co and Tourism Holdings. Both of those stocks have performed quite poorly over the past 12 months, and I was pretty optimistic that the improving international tourism arrivals was going to be good for both of those businesses. And if you look at it, they both actually traded at their highs the day borders opened. And as the tourism has recovered, the share price has gone down. So there's some stock-specific issues there at Tourism Holdings. They actually sell their camper vans, as we've seen with the car dealerships. Nobody wants to spend money on big ticket items, so that's hurt their short-term profitability. But I do still think the story is intact there for more international tourism, particularly Chinese tourism. I think we'll have a summer that's pretty close to 2019 this year, in summer 2024, and that's going to be good for both of those businesses. So you might need to be patient, but it's been a very costly investment for us over the past 12 months.
Lost a bit of sleep, have you?
I don't tend to lose a lot of sleep personally. I've been through a lot of these cycles.
As fund managers, you do need a lot of sleep to keep going. So Luke, what have you got wrong? Tell us about your worst call over the last 6 months.
I think lithium has been my worst call from the last 6 months. I mean, lithium price is down 20%, and Pilbara Minerals in our portfolio, whilst I don't lose a lot of sleep over it, it's a pretty solid business with a decent balance sheet. certainly is down and it has been a drag on portfolio performance for us. Look, medium term, probably a bit like Steve, I've got some faith there, and I think the supply demand dynamic will kind of play out in our favour over the longer run. But in the short term, there's certainly some bearish, some sort of weak sentiment in China and weak sentiment around EVs more broadly at the moment. So while that's around, these stocks are going to continue to trade at discounted valuations.
Yeah, Pilbara is down 20% year to date. What are your thoughts on this? Where is it going to go in the next 6 months?
Look, I think it might sort of trade sideways for the next little while. Sort of expecting lithium price to maybe pick up towards the end of the year, and certainly, I think Pilbara is going to continue to trade in line with that in short term. I think over the longer term, though, if the stock does get a lot lower, it does have a lot of strategic value there for a potential buyer, either overseas or someone consolidating from the US. So I certainly don't see Pilbara being a problematic shareholding for us long term, but it might be a continued drag on performance, particularly if the markets keep ripping, but the lithium price doesn't.
Now, this is meant to be a little bit of fun. We know you both run diversified portfolios, and it's just a bit of a fun question. If you could put your house on one stock over the next 6 months to outperform, what would it be and why?
This is exactly what I tell people not to do, but we'll do it.
This is not advice.
Yeah, we'll do it anyway. I think for me, Webjet would be my pick. Just saw a company, TBO Tech, list overseas on 37 times EV to EBITDA, which does pretty much the same thing as WebBeds, despite the fact it does half the transaction volume of WebBeds and trades on half the margins. Webjet's trading on 13 times. Wow. So, it's a much cheaper business, equally as good. I think management realise that. They're seeing the value of, Booking and Expedia and Airbnb overseas and going, well, we've got one of these inside our business, and no one's paying any value to it. So from my perspective, I think this strategic breakup's going to unlock a lot of shareholder value, create two really viable takeover targets, different sort of acquirer potential, but certainly two takeover targets, and I think there's significant value to be unlocked for shareholders there.
Tourism for Luke. Steve, what would you bet the house on and why?
Look, I think to add to the caveat, our whole strategy is actually to look through the next 6 months. I think people that get caught up trying to work out what's going to happen in the next 6 months miss some great opportunities. So looking out further than that for me, it may happen in the next 6 months, but it's probably more likely a bit later. I think Catapult is going to get a lot of market attention.
Okay.
It is a business that has disappointed people for a long time, and I think it's in a lot of people's dog boxes still, i.e. I don't like what the management team did here, I don't want to invest in that company, and therefore I don't look at it as closely as I probably should. I'm guilty of that myself across quite a few stocks. I think EML is a good example of a stock that we have invested in recently because my co-portfolio manager said to me, you actually really need to look at what's changed here. Forget about what you thought 2 years ago.
Strategic
this business
review
has changed substantially and you need to take another look at it. And I think Catapult's in that category, and it's on the cusp of, I think it can be a business that a lot of people love. It's got a huge runway of growth ahead of it. They're in almost every professional sporting competition in the world. At the moment, they're only 17% penetration, but nobody else is anywhere near them. And that market is growing. There's women's sport, there's younger grades, there's other sports that weren't professional becoming professional. So I think it just gets bigger and bigger, and it's trading at a pretty sensible multiple today of what I think it could make if they stopped investing in the growth. And now you're seeing that growth come through in growing cash flow. Within a couple of years here, it's going to be a fairly low multiple of earnings and growing at 20 and 30% per annum.
It is up 33% year to date though. Does that sway in your opinion, or is that
not at all? I actually think some of the best opportunities, I think both down and up, often some of the best opportunities are when you get some really important news, and you've had it here at Catapult over 18 months, a consistent set of results. The share price goes up 20 and people like me go, I don't want to invest in that stock because it's up 20%, and sometimes they should be up 50, they should be up 100. And sometimes buying a stock that's already gone up is a better idea than buying one that's gone down, although we look at both ends of that spectrum.
Just look at Nvidia, the story tells itself, doesn't it? Well, that's all we have time for today in this episode of Livewise Buy, Hold, Sell. I'm Grady Wulff. If you enjoyed that educational episode, don't forget to like it. And if you do enjoy everything we put out, why not subscribe to our YouTube channel? We're adding so much great content every single week.